Okay, first of all, before going to further detail of bank reconciliation, first let's try to understand the concept. For example, you receive some cash in the business. This is your asset. And asset by nature is debit. When you are receiving the cash, it will increase and debit increase, debit. Then you deposit this cash to the bank. Now from your point of view, from business point of view, whether you have cash in your pocket or you are having cash in the bank account, both will be treated as an asset. But when you deposit this cash into bank, let's try to see from bank perspective. Bank is receiving this cash from the customer, which is you. And bank, when they receive this cash from the business, so bank knew this thing that, okay, I'm just holding this cash on behalf of business. And in the near future, when this business asks me for or demand me for cash, this is my responsibility to return this cash on demand. So basically, when bank receive cash from the business, from the bank point of view, this cash will be treated as a liability. Liability toward customer. And liability by nature is what? It's credit. Whenever bank receive more cash from the customer, liability towards customer, let me write here, liability towards customer will increase. And credit increase, credit. Now I decided to withdraw this cash from the bank. Now from bank perspective, what will be happening? When I withdraw cash from bank, so from bank point of view, this cash was liability. Liability by nature is credit, liability toward customer. And liability by nature is credit. Now when customer withdraw cash, so liability towards customer will decrease. And credit decrease is debit. And same when I receive cash, I will say, okay, I withdraw money from my bank account. Balance in my bank account will decrease and balance in my cash book will increase. So from customer point of view, what is happening? When I'm having cash in my business, this is my asset. Or whether I'm having cash in my bank account, it's also my asset. When I deposit money into bank, so what will happen? Cash in my business will decrease and cash in my bank account will increase. So when I deposit money, from business perspective, when I deposit money, I will say bank as an asset will debit because it increase and cash book balance will decrease, so it will credit, let's say with $1,000. But when I withdraw money from my bank account and I bring it to business, totally opposite entry. Cash in the business will increase, debit with $1,000 and bank account, as the balance of the bank account will decrease, it will credit with $1,000. And from the bank perspective, when bank receive cash from the customer, bank liability toward customer will increase. But bank, when they give some money to the customer out of their bank account or bank make payments out of the business bank account, so the liability toward customer from bank point of view will decrease. So this you need to understand that whenever we see bank statement, who prepares bank statement? Obviously the bank staff is preparing the bank statement. So if bank is saying that I'm crediting your account, mean I'm increasing my liability toward customer, I receive some money. And when bank is saying I debited your account, so mean they decrease liability toward customer, mean they made some payment. And from business perspective, whenever they deposit money in the bank, their asset will decrease. Their cash in hand will decrease. And when they take back money from the bank, the cash in hand will increase. So cash book, they always prepare from the business point of view, and the bank's statement as it is prepared by the bank staff, so this will always be prepared from the bank point of view. Okay, now let's talk about the reasons that why we can have differences between cash book and bank statement. Again, cash book is prepared by our business and bank statement is prepared by bank staff. What can be the reasons? The reasons basically for the differences, there can be two types of differences. Temporary difference and permanent difference. What are permanent differences? Permanent differences are because of errors. Who made the error? Maybe business made error in the cash book. And if there is an error in the cash book, so definitely the balance of cash book will not match up with the bank statement. Or humans are also working in banks, so there can be an error in the bank statement. So if there is an error in the bank statement by bank staff, that will also be there. And if there is an error in the bank statement, obviously bank statement balance will not match up with the cash book. So due to these errors, the cash book balance will not match up with the bank statement. This is what we call permanent difference. Now, if there is an error in the cash book, so we need to make correction where? In the cash book. If there is an error in the bank statement, we need to notify the bank about the error and we need to make adjustment where? In the bank statement. Second, there can be one more type of permanent differences, that sometimes there are transactions which appear in the bank statement but it does not yet appear in the cash book. For example, standing order. Whenever there is a standing order payment, so first it will deduct from your bank account, first it will appear in the bank statement. Once you receive the bank statement, then you have to make adjustment in the cash book. Similar to this, direct debit, then contactless payment like Google Pay or Apple Pay. Okay, so contactless payments can be there, or any sort of, bank cards. So all these are what? These are automated payments. So if there are any sort of automated payments or receipts, so obviously these will appear in the bank statement first, and then upon receipt of bank statement we need to perform bank reconciliation, and whatever items are appearing in the bank statement but not in the cash book yet, so we need to record them in the cash book. So these are what? Errors, or there are some payments which only appear in the bank statement but not in the cash book yet. So these are permanent differences. So what we need to do? We need to make sure that we need to make corrections in cash book. And if there's an error in the bank statement, we need to notify the bank and we need to make adjustment in the bank statement. Then again, for example, bank interest and charges, this can be a good example. If we are receiving some interest from a bank on our saving accounts, for example, or if bank deducted some charges, for example, checkbook charges, for example, or maybe ATM servicing charges or so on. So if bank is paying me some interest or they are deducting some money from a bank account as bank charges, they will also appear in my bank statement first, and then I need to record it in the cash book. This is also an example of permanent differences. So permanent differences will not resolve automatically. We need to perform bank reconciliation and we need to make adjustments. Then what are temporary differences? There are two types of temporary differences. Unpresented checks or uncredited checks. What are unpresented checks? For example, I am having business A and I want to pay money to my supplier S. So what I will do, I will write down a check as what? As a payment, because check is my payment. So I will write down a check payment and I will record it in my cash book. And cash book is my asset when I'm paying money to my supplier through check. So obviously the balance in the cash book will decrease. So I will credit my cash book. Now I send this money to my supplier. Now logically, supplier should go to my bank and he should collect the money. So when supplier take the check to my bank need to reduce my balance and make payment to the supplier. But what if due to any reason I sent the check to the supplier, I recorded in my cash book as a payment or as a credit, but supplier didn't presented the check to the bank. It doesn't mean he will not present it. Maybe after he was busy in some other task and maybe he will present it next week, for example, maybe next month. So what is happening that in my cash book, I recorded this check as a payment, but the check is not yet presented to the bank and bank didn't reduce my balance. But I knew this thing that in near future, bank will reduce my balance. Now this is basically what we called unpresented check. Remember, this is not an error. This is just a timing difference. I recorded something or a check as a payment, but this is unpresented to the bank and bank didn't reduce my balance, but bank eventually will reduce the balance in the near future. So this is called timing difference. Second, uncredited checks. For example, customer C make payment through check to my business A. I received the check. Now I deposited this check to my bank. Or before that, first of all, I will record this check as my receipt. Where? In the cash book. So I will say I receive a check from a customer and I receive some money, so I will debit my cash book. Then I deposited this check to my bank. But bank received the check and they sent this check to the clearing house, and you know in clearing house it can take 3 to 5 working days to verify everything and to process the check. Now I already recorded the receipt in the cash book as a debit, but bank didn't credit me yet. Why bank need to credit me? Because when bank is receiving money from the customer, so bank will say my liability toward customer will increase, so bank need to credit our account. So bank didn't complete this process, but eventually bank will complete it in near future, but not yet. So now what is happening? In cash book, I already recorded the receipt, but in the bank statement, there is no deposit from my side. It appears like this. But in the near future, the process of the clearing system will complete and bank eventually will give me credit. And then automatically the cash book and bank statement, both balance will match up. This is what we called uncredited checks. So unpresented checks, there are payments recorded in the cash book but not yet presented in the bank, and bank didn't reduce the balance. Uncredited checks, these are what? These are receipt in the cash book. These appear as a receipt in the cash book, but bank didn't complete the process. So that's why bank didn't increase my balance, but eventually they will increase it. So unpresented checks and uncredited checks, both are temporary differences. We need to spot them, we need to identify them, and we just need to make adjustments so we can see that when these timing differences will solve, after this my cash book and bank statement balance match up or not. So these are the reasons. Two are main reasons, temporary reasons. For temporary reasons, you just need to see after recording these, like unpresented checks. So unpresented checks you already recorded in the cash book as a payment, but the bank didn't reduce the balance yet. So reduce the actual balance and see your cash book and bank statement balance match up or not. Uncredited check recorded as a receipt in the cash book, but bank didn't increase the balance. So increase the balance and see whether your cash book and bank statement match up or not. So about the temporary differences, we just need to make an adjustment that what if when transaction completes, so how our balance will look like. And permanent differences are problems, and thus if there is an error or a mistake on bank behalf, we need to notify the bank. And if there are some transactions which appear on the bank statement but not in the cash book yet, we need to record them in the cash book. So I hope you are clear with these two types of differences. Then with examples, we will going to practice it out.